welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is Tuesday, November 7th of 2023. We're going to talk about three things that are moving markets. Markets are paying attention to, so you should too. Thanks for watching. Right now we're going to talk about the bank credit declining, especially in the commercial real estate space, and what the ultimate impact is to the overall economy, as well as unemployment worries. We're still worrying about that. The Federal Reserve is, and we'll check in to see where we are with that. And then a year-end rally predictions is what everyone wants to see and everyone's hoping for. So let's get to the data and see what happens with that. But let's start off with the commercial U.S. commercial banks and ultimately their credit that they're providing or the ability to lend. And ultimately, all you're going to see here is probably not a secret. For the most part, this is, ultimately in March of 2000 when we started COVID and all the years after COVID. But right now, we're right here, and it's just showing ultimately that the commercial banks are not lending, obviously, on a lot of the categories like office and so on and so forth. So this has a negative impact on society simply because if credit is not provided, especially to businesses, and small businesses are the engine of the economy, they're employing the most, not big companies, small companies all across the United States. They're the ones that have the pulse of the health of the U.S. economy and the employment gauge. So let's take a look at the impact on U.S. banks tightening lending versus job losses. And what you're going to see is the blue line here are U.S. permanent job losers over that period of time, historically speaking. Look at the last 30 years. And the red dotted line are bank tightening standards. So when you see that the banks are tightening, historically speaking, they're pulling back on credit as they are now, and they're doing it once again. What happens and what follows through is this green, or actually the blue line spikes, and that's the unemployment did in COVID. And right now, the question is, what trend are we going to see? Historically speaking, if we look at least the last three data sets and the last three recessions that historically have been sort of in line, and that's what we could potentially expect moving forward right now. Now, the unemployment rate, again, we're going to see this line. The Federal Reserve wants to see this go up. We're just under 4%. I think 3.9% was the most recent read. So it's moving up. And, ultimately, we don't ever want to see this go spike straight up, but that would relieve pressure in the economy. Again, two more spikes up here for the unemployment. It's just showing that the cumulative effect of interest rates rising is having a negative effect on individual companies, right? And individual companies that have to pay more for debt or are going to be concerned about the U.S. economy moving forward might not want to add on an extra employee right now or look to reduction in workforce at this moment in time. Again, the Federal Reserve is worried about this, which is the average year-over-year earnings and how wages are inflation. So inflation's down on a basically downward trend. Wages is the number one thing we want to see, and weekly wages. So right now, this is all going in the right direction for the Fed. Because it's relieving the inflationary pressures that are being built in. So Federal Reserve is actually winning in this moment in time. This is talking about sort of the moving averages of what I just showed you in the previous slides. And historically speaking, in the last three recessions, when we get those numbers that I just showed in the pattern that we just showed, the smoothing averages, if we see more than a 0.5% change, which we have, the question is, will we see a recession this time? And the potential is yes. But now let's get to the moment you've all been waiting for. But Rob, we've had sort of an August, September, and October seasonal pullback in markets. Over 80% of the S&P 500 have met or exceeded the S&P 500 targets for earnings, both on the top and the bottom line. So corporate America is showing that they're healthy. That's why markets had a relief rally coupled with the Federal Reserve being on pause, higher for longer, but being on pause on last week's Fed meeting. So what happens now? Is this the start on an onset of a Santa Claus rally? Again, we don't really know, but we can look at the historical seasonality going back to 1950 to 2022. And on the left, you're seeing the average access of basically this deep blue line right here is showing that we see a pullback at that period of time. This, again, August to October. And then the fourth quarter, we have the Santa Claus rally, historically speaking, on average for the S&P 500 or the market in general, going back to 1950. Now, this is where we are today. And we see this big reversal of the last couple of weeks. Markets have rebounded. Do we continue on this path higher? Remains to be seen. But a lot has sort of wins in the sales for seasonality, a relief over the third quarter, some solid numbers coming in from corporate America. So I think there's an opportunity for us to see not 100%, strong rally, but we could see the market itself sort of test where they were leaving off earlier this year, try to push markets higher. Again, this is just a suggestion that that the opportunity is there in terms of the money flow in the markets, and both what we've also seen is money markets have historically seen super highs right now, and this is year to date in terms of money market right here is almost at the money market rate as it was. And what happens is it's cyclically defining. Ultimately, when money markets are at their ultimate high, that's ultimately when you can see markets take off, because it always finds the arbitrage. Markets always find the arbitrage. And ultimately, we got a lot of money managers, institutional managers, even retail America that are offsides, meaning they didn't get the gains they wanted to or hoped for year to date. And when we see historically that much money in the money market waiting for an event, usually we see markets sort of hit higher highs in that meantime, and then have a volatility event from that point forward. Again, catching everyone offside. So that's where you kind of have to have sort of a balanced portfolio. Constantly check in with us here if we're managing your portfolio of Blanke Schein Wealth Management. We're doing our 2024 planning calls and in-person reviews. We're talking about updating your financial plan, making certain your portfolio is a reflection of your current situation, life, your goals, your feelings. So give us a call if you haven't heard from us just yet. And we're also looking at basically offsetting year-end cap gains. So if you have portfolios out there or a real estate transaction and you want to offset some cap gains, give us a call. We can help you do that in the portfolios that we're managing here directly. But with communication is key. So pick up the phone, give us a call, or we'll be reaching out as well. Thanks for watching, and we'll see you again next time.